So imagine you go to a casino, right? You hit the absolute jackpot on the high roller tables. And when the floor manager comes over with like a giant ceremonial check, you just shake your head.
You turn it down.
Yeah, you turn down the check. Instead, you demand that they bring out 2 million pounds of physical pennies, and you load them into a literal fleet of armored trucks and drive them to a private vault you just built on the exact opposite side of the world.
Which just sounds completely absurd.
It sounds insane, but the crazy thing is, that is essentially a perfect reflection of what the world's most powerful financial players are quietly doing with the global economy right now.
It really is. And I mean, it completely shatters the illusion we have when we, check our stock portfolios, we pull out our phones, we look at the sea of red and green numbers flashing on a financial app, and we just assume we are seeing reality.
Right.
But those digital tickers are completely masking a massive historic restructuring of physical wealth that's just happening in the background.
And that silent restructuring is our mission for this deep dive. Today, we are pulling from a fascinating breakdown by a YouTube channel called The Bullion Brief.
Yeah, featuring financial commentators Robert Kientz and Andy Schectman.
Exactly. And we are going to explore a literal physical run on gold and silver that is completely defying decades of normal market behavior. And the mainstream media is, for the most part, just looking the other way.
They really are. And, to really understand the magnitude of this shift, you have to temporarily just ignore the daily financial news cycle. I mean, the headlines are obsessed with quarter-point interest rate moves or tech earnings.
Always the tech earnings.
Right, but beneath all that digital noise, sovereign nations and the absolute largest financial institutions are executing this coordinated scramble for physical elemental assets.
Okay, let's unpack this. Because the immediate anomaly happening on the trading floors, specifically places like the COMEX, which is the primary commodities clearinghouse in New York, it is wild. Because for decades, the way investors traded precious metals on these exchanges was essentially this sleepy digital gentleman's agreement.
Yeah, nobody actually wanted the heavy metal.
Right.
The historical norm was almost entirely a paper game. And to understand why this is breaking down, you really have to understand the mechanics of a warrant.
A paper warrant.
Exactly. When you buy a futures contract for gold or silver, you are eventually issued a warrant. And mechanistically, this is just a legal document stating that a specific numbered bar of metal is sitting in an exchange-approved vault, and you are technically the owner.
But practically speaking, actually taking delivery of that bar is an absolute logistical nightmare.
Oh, it's terrible.
Because I would imagine the insurance alone is just staggering, let alone the logistics of moving literal tons of metal securely across borders.
The costs are astronomical. I mean, you have to hire armored transport, arrange secure multi-jurisdictional logistics, pay massive insurance premiums.
Wow.
And you have to undergo strict chain of custody audits. Because of that friction, historically, barely 1% of contract holders ever stood for physical delivery.
Just 1%?
Yeah, the counterparties would just trade the paper warrants back and forth, settling their profits and losses in cash.
But the source material indicates that since 2020, this sleepy paper market has been completely upended. Like the counterparties are suddenly rejecting the cash settlements.
Right, they don't want the cash.
They are holding up their warrants and demanding the actual numbered bars be pulled out of the vault and loaded onto those armored trucks.
And the sheer volume of this drain is what caught the attention of Kientz and Schectman. I mean, in February alone, 39 million ounces of physical silver stood for delivery and actually left the exchange.
39 million ounces. Wait, that is the 2 million pounds I mentioned earlier.
Over 2 million pounds. It equates to roughly $1 billion worth of silver physically driving away in a single month.
That is insane.
It is. That number represents about 160% of what the normal historically expected deliveries could even begin to explain. And the gold market is seeing the exact same stress.
Really?
Yeah, take the month of June, for example. In the traditional cycle of commodities trading, June is generally a weak month for gold deliveries.
Right. The heavy volume usually hits in December, doesn't it?
Exactly. Yet, before June was even over, we saw over $13 billion in gold contracts stand for physical delivery.
Let me push back here, though. Because we have seen high inflation cycles before. Like whenever the consumer price index runs hot or there is geopolitical tension somewhere, retail investors always flock to gold coins because they are scared.
Sure, they want a safe haven.
Right. So isn't this massive volume just a normal cyclical reaction to the inflation we've seen over the last few years? Like, why call this a historic anomaly instead of just standard market fear?
Well, what's fascinating here is that the underlying mechanics of this movement completely disprove the retail fear narrative.
How so?
Because mom-and-pop investors buying gold eagles don't drain the COMEX of 2 million pounds of industrial silver bars in 28 days.
Okay, fair point.
This is institutional. And, more importantly, it is sovereign. And the reason we know this is a systemic restructuring rather than just, a temporary inflation hedge is by tracking exactly where those armored trucks are actually going.
Right, because they aren't just driving down the street to a different vault in Manhattan. They are leaving the Western financial system entirely.
They are crossing oceans.
Yeah.
I mean, for the better part of a century, global bullion pricing, custody, and trading infrastructure was entirely dominated by London and New York.
They were the center of the universe for this stuff.
Those two hubs were the undisputed toll booths of the gold and silver markets. But the massive physical drain we are seeing in the West is directly feeding an unprecedented buildup in the East.
It is like participating nations are building an entirely new, parallel, global highway system because they no longer trust the infrastructure or, the people running the toll booths on the old one.
That's exactly it.
We are seeing a massive flow of metal out of the West and straight into the Shanghai Gold Exchange.
Right. And China has been aggressively strengthening that exchange to rival the West. And the logistical realities of that move are reshaping neighboring economies as well.
Because it has to go through Hong Kong, right?
Exactly. When gold comes out of mainland China, it generally has to route through Hong Kong,
Right.
which is basically transforming Hong Kong into an absolutely vital, massive vaulting and clearing hub for the entire region.
But the source material makes it clear this isn't just a bilateral shift between the U.S. and China. Singapore is also positioning itself as this mammoth hub for physical settlement.
Oh, definitely.
There is a group called ABX that is establishing a brand new physical delivery market right there in Singapore.
And the ABX development is crucial because it is a direct structural strike against the Western paper model. I mean, they are building a system specifically designed for physical exchange.
Bypassing the whole fractional reserve nature of Western bullion banks entirely.
Exactly. And this alternate infrastructure is expanding deep into the BRICS nations and their allies. We are talking about a vast, interconnected network of multi-jurisdictional vaulting and clearing systems.
Spanning Saudi Arabia, the United Arab Emirates.
Russia, specifically in St. Petersburg.
Right, and India down in Mumbai, and all the way across the globe to Brazil.
Which means these nations are actively building the capacity to price commodities, manage cross-border settlement, and maintain physical custody of their own national wealth without ever having to route a single transaction through a Western bank.
It's a complete bypass. And the source material gets into some really deep commentary on China's specific role here. They cite Eastern financial analysts, specifically Jingu, who is apparently known in financial circles as the Oriental Ghost.
What a nickname.
Right. And Xiaobai as well. And these commentators suggest China is playing a much longer game with this metal.
Their thesis is that China is just tired of absorbing the inflation exported by the United States. Rather than just competing on sheer manufacturing output, China is positioning its currency, the renminbi, for a much larger, dominant international role.
Makes sense.
And if you want to challenge the U.S. dollar's reserve status, you can't just ask the world to blindly trust your fiat currency. You have to project unquestionable financial stability.
And nothing projects stability to foreign central banks quite like a currency that is backed by tens of thousands of tons of physically vaulted, unencumbered gold.
Exactly.
Because if China backs the international valuation of the renminbi with this massive accumulation, it fundamentally alters the global settlement landscape.
It creates a viable hard asset alternative to the dollar system. And that brings us to really the most important question. Who exactly are the architects of this massive transition?
Right. And the source material uses a brilliant term from the sports betting world to describe them. They call them the sharps.
It's a great analogy.
I love it. Because in Vegas, the sharps aren't the tourists throwing money at the roulette wheel after a few free drinks. The sharps are the professional syndicates.
The ones who actually know what they're doing.
Right. They have the absolute best analytical models, the inside track on injuries, the deepest pockets, and they move the betting lines before the public even knows what is happening.
And if we connect this to the bigger picture, Central banks are the ultimate financial sharps of the global economy.
Mhm.
They're the ones vacuuming up this physical metal.
They really are.
And the irony is profound. These central banks are the exact institutions that issue our national fiat currencies. They have access to the most granular real-time economic data on the planet.
Yeah, they see everything.
And while they publicly defend the strength of their own printed money, their private actions reveal a completely different strategy. They're relentlessly accumulating the one single monetary asset that they cannot print.
The history behind that contradiction is pretty grim, honestly, because the source points out a sobering track record. Every single major fiat currency in human history has eventually failed.
Every single one.
They've experienced massive devaluation or required total restructuring, and they trace this unbroken streak of failure all the way back to the very first fiat currency issued in China in 1158.
It didn't last, and neither has any unbacked paper currency since. Gold, however, has an unbroken, multi-millennial track record of preserving purchasing power.
Through world wars, hyperinflationary spirals.
Banking collapses, total regime changes.
Mm.
But the central banks aren't just buying gold because of history. They are buying it because of an immediate, glaring structural crisis they are actively managing right now.
And this is where the contradiction becomes almost surreal for anyone paying attention, because we are watching world leaders and policymakers aggressively push the public toward a completely digitized financial future.
Oh, constantly.
We hear endless talk about central bank digital currencies, CBDCs, stablecoins, and the total modernization of payment rails. So, if the architects of the financial system are loudly proclaiming that the future of money is entirely digital, why are they quietly hoarding the oldest, heaviest, most analog asset on Earth?
I mean, it appears contradictory, but mechanistically, it is a highly coordinated hedge. The central bank sharps know exactly how fragile the current architecture is.
You have to.
They are watching global sovereign debt reach mathematically impossible highs. They see the interest payments on that debt eating up larger and larger percentages of public budgets, which basically guarantees further debasement of the currency.
Right.
They know the transition to a new digital system is inevitable.
But you can't just launch a new digital currency out of thin air and expect global markets to trust it, especially if the old currency just collapsed under the weight of its own debt.
Precisely. Because if a central bank introduces a CBDC backed by nothing, the market will reject it. But if they anchor that new digital system with a massive audited reserve of a Tier 1 pristine asset like physical gold, they instantly manufacture global credibility.
Wow.
And this isn't just theory. We are seeing this play out in global banking regulations right now with Basel III.
Okay, we need to pause and explain Basel III because that sounds like deep banking jargon. But from what I understand, it completely changed the legal definition of gold for these banks.
That fundamentally altered the landscape. I mean, for a long time, banking regulations considered physical gold a somewhat risky asset.
Really? Gold was risky.
From a regulatory standpoint, yeah. If a bank held gold on its balance sheet, regulators forced them to apply a haircut to its value, meaning they could only count a percentage of its actual market value toward their required capital reserves.
Oh, I see.
But the new Basel III regulations reclassified physical allocated gold as a Tier 1 asset. Mechanistically, regulators now allow banks to treat physical gold exactly the same as cash.
Which means hoarding gold suddenly has massive utility for a central bank's balance sheet. And, to be clear to you listening, we're just reporting what the sources found here, not taking sides. But this anxiety about the fragile state of our current unbacked system isn't just an Eastern BRICS phenomenon.
Not at all.
It is deeply embedded in the current political and economic discourse in the United States right now.
You see this recognition across the domestic political spectrum. I mean, figures like Donald Trump have been very vocal about the fragility of the U.S. dollar's dominance.
Right, pointing out that the existing financial infrastructure, the way we handle treasuries and payment systems, is severely compromised and essentially ripe for a digital overhaul.
And simultaneously, you have serious policy architects exploring how to anchor that American overhaul to hard assets.
Yeah.
The source highlights Paul Winfrey, a former White House deputy assistant.
Yeah, he authored Chapter 24 in the Mandate for Leadership, which is this massive, comprehensive policy document.
Right. And in that chapter, he does a deep dive into exploring a return to a gold standard, or at least running a parallel gold-backed system to combat the boom and bust inflation cycles driven by the Federal Reserve.
Winfrey specifically explores the mechanics of gold convertible treasury instruments. This mirrors proposals by economists like Judy Shelton, who have advocated for U.S. gold bonds.
Exactly. The underlying premise is the same whether you are in Washington, Beijing, or Singapore. The current debt-based fiat system has a mathematical expiration date.
Here's where it gets really interesting, though. If we have this unprecedented, insatiable physical demand from the most powerful, well-informed entities on the planet, if sovereign nations are emptying vaults and changing banking laws to hoard the metal, why do we still see the price of gold and silver suddenly drop on our stock apps?
It's a huge disconnect.
It is. The source mentioned a recent Yahoo Finance article declaring that the devaluation trade is gone, implying the dollar is perfectly strong and the precious metals rally is over. How does the mainstream financial media look at this massive physical drain and conclude that nothing is happening?
Well, this raises an important question about how prices are actually discovered in modern markets. To understand the profound disconnect between the physical reality and the digital price tag, we really have to look at the mechanics of the paper illusion.
Okay.
And that all starts with the 1974 Commodity Act.
Which was passed just a few years after the U.S. dollar was taken completely off the gold standard, effectively throwing the price of gold into the open market.
Right. And the original intent of that 1974 Act was incredibly practical and honestly beneficial. It was designed to help legitimate producers and consumers hedge their physical business risks.
So, like, the actual people mining or using it?
Exactly. Imagine you are a silver miner in Mexico. It costs you a certain amount of money to pull silver out of the ground, and you need to know you can sell it for a profit next year, just to keep the lights on.
So you use the futures market to lock in a guaranteed sale price today, protecting your operation from a sudden market crash.
Yes. Or, on the flip side, if you are a massive electronics manufacturer that needs tons of silver to build circuit boards, you can lock in your purchase price to protect yourself from a sudden spike. It was an insurance market for people who actually touched the physical commodity.
But today, that vital commercial function has been completely swallowed by rampant financialization. The source points out a staggering metric. 98% of the trading in this market today is non-hedging.
98%.
It is not miners securing their payroll, and it is not manufacturers securing their supply lines.
No, it is massive financial houses, algorithmic traders, and pools of speculative capital operating out of server farms in New Jersey.
They are betting billions of dollars on whether it will rain, but they don't own an umbrella, they don't know how to manufacture an umbrella, and they have absolutely zero intention of ever standing in the rain.
That's exactly what it is.
Meanwhile, the central banks, the entities actually standing in the storm, are quietly buying up every single physical umbrella they can find.
And that dynamic creates a massive blind spot in price discovery. The algorithmic trading bots that dictate the minute-by-minute price of silver on your phone app aren't programmed to monitor the physical drain from the Shanghai vaults.
They don't see the trucks.
No. They are programmed to scan the volume of paper contracts being traded. Because the volume of paper trading is astronomically higher than the physical trading, the algorithms price the metal based entirely on the paper sentiment. The market is effectively blinded to the physical reality.
And the source is very specific about who controls that paper sentiment. They highlight a heavily concentrated short position. The top 8 bullion banks in the world own almost 50% of the short contracts on gold and silver.
Mechanistically, a short contract is a leveraged bet that the price of the asset will go down. When a tiny handful of massive institutions hold half of those bets, it acts as a structural suppression mechanism.
So if physical demand starts driving the price up,
These banks can simply flood the digital exchange with thousands of paper contracts, those warrants we discussed earlier that no one ever used to physicalize.
and this massive influx of artificial paper supply tricks the algorithmic traders into thinking there's a glut of metal, which artificially drives the price back down.
Exactly.
It completely detaches the price from reality. It reminds me of the commentary the source brought up about the oil market a few years ago. We literally saw the financialization of oil push the price of a barrel into negative territory.
Oh yeah, that was wild.
On paper, you were getting paid to take delivery of crude oil, but that wasn't reality. You couldn't go to a gas station and get paid to fill up your tank. It was a paper market that had completely lost its tether to the physical world.
And the oil anomaly proves that paper markets can completely hallucinate. But the hallucination only lasts as long as the market accepts paper settlement.
Right.
These algorithmic traders can ignore the Basel III regulations, they can ignore the internationalization of the renminbi, and they can ignore the trucks leaving the COMEX for a while. But eventually, physical demand asserts itself.
Especially because you cannot build an electric vehicle battery with a paper warrant. You cannot back a sovereign digital currency with a digital derivative. You need the actual metal.
And that is the crux of the restructuring. If hubs like Shanghai and Singapore mandate physical settlement, while London and New York continue playing a highly leveraged fractional reserve paper game, the disconnect eventually becomes mathematically unsustainable.
The paper illusion shatters against physical scarcity.
Exactly.
So, what does this all mean for you listening to this right now? How do you navigate a financial landscape where the stock ticker on your phone is telling a completely different story than the armored trucks leaving the vaults?
The most important takeaway is to just stop reacting emotionally to the daily volatility of paper futures markets. When you see a sudden drop in the spot price of gold or silver, understand the mechanics behind it.
Don't panic, sell.
Exactly. Do not let algorithmic paper trading convince you that the underlying macroeconomic fundamentals have changed. You need to focus on the architectural shift. Ask yourself, who is accumulating the physical metal? Where is that metal moving? And why are the smartest financial players in the room preparing their balance sheets for a systemic transition?
You do not need to obsess over tracking daily prices. You just need to watch the sharps. The central banks are actively telling you through their actions that the current debt-based system is reaching the end of its lifespan.
They are.
They are quietly building a lifeboat of physical assets to protect against currency debasement, while simultaneously laying the groundwork to launch a new, digitally anchored financial system.
And the transition is happening right now, whether the mainstream financial media chooses to report on the physical drain or not.
Yeah.
The paper illusion can only suppress the physical reality for so long before the vaults run dry.
Which leaves us with a truly fascinating and maybe slightly unsettling thought for you to ponder long after this conversation ends.
Oh boy.
If the BRICS nations and the East successfully scale up these massive physical delivery-only exchanges, and the Western institutions stubbornly refuse to abandon their unbacked paper trading, could we soon wake up to a fractured global economy where the exact same physical ounce of gold has two completely different prices? A suppressed paper price in New York and a massively premium physical price in Shanghai.
I mean, a two-tiered pricing system would represent a total paradigm shift. It would mean the West has lost its ability to dictate the measurement of global wealth.
Next time you look at that financial app, just remember, the numbers flashing in red and green are only the casino chips. The real game is being played with the heavy metal slipping quietly out the back door. Thank you for joining us on this deep dive. Keep questioning the consensus, and we will catch you next time.